But the point is, this is really out of control. I mean, this government is out of control. And you had a presidential debate where no questions were asked about the fiscal or economic, situation or balance sheet of the U.S. government. Nobody dares to go there. I mean,
Right.
it's just not talked about. And yet, there's a train wreck coming, a big, big train wreck. I tend to be of the David Hunter camp that we're going to go into a melt up, just that they're going to continue to cut rates. And it's, this is the biggest stock and everything bubble in the history of the world. And it's going to, in my view, get bigger. But that doesn't mean that at some point it won't end.
In this recent interview with Natalie Brunell, Larry Lepard addresses three crucial topics: the Federal Reserve's rate cuts, the looming debt spiral, and Bitcoin's future amid global financial instability. At the time of the discussion, Bitcoin is trading around $60,000, showing a 2% decline over the past 24 hours and a 7% drop in the past week. With the 2024 elections approaching and new crypto regulations on the horizon, this conversation underscores the intersection of economic policy and the crypto market. Before we continue with the rest of the video, do check out daily 5-minute crypto newsletter with all the latest crypto and Bitcoin news. It's a fantastic analysis of on-chain crypto data and breakdowns, and the best part is it's absolutely free. They'll cover expert predictions, breakdowns of on-chain crypto data, and any breaking news you need to know, all in a nutshell. Click the first link in the description and enter your email to join over 50,000 others in becoming a better crypto investor right now.
Right.
And at some point there will be no buyers left, and it will end. And it will end very badly. And when it starts to break, I mean, they can't handle a lower market. And when the stock market starts to break, the negative wealth effect, et cetera, is going to flow through to everything. And as James points out, in 08 and 2000, when we had those big market downturns, the deficit grew between 6 and 10% because, tax receipts come down from the stock gains and costs and social costs go up. So, we're running a big 7%, 6-7%, GDP deficit right now. Imagine when that doubles in size, and then the bond market fails, and the only way to solve that is to go buy all the bonds. So, the Fed balance sheet goes from 7 trillion to, take 36 and add it to 7, right? I mean, there's really an unbelievable train wreck coming at some point. But until that time, hey, the band is playing on the Titanic and everything looks fine. Now, where's the iceberg? I don't know. I mean, I'll tell you one other macro data point that I think we should discuss, because to me, this actually drove gold in a big way. And I think it shocked a lot of people. Last month, or a couple weeks ago, they reported last month's federal monthly deficit, right?
Yeah.
And it was $380 billion in the month, 90 billion more than forecast. They were forecasting a deficit of 290 and they came in at 380. I mean, and I think that was, I don't know if you remember when that occurred, James, but gold and silver took off like rockets when that was announced. And, I think, right. I mean, now this stuff's lumpy, so you can't take that month times 12, right? But, you've got to actually hold assets which cannot be debased, because we know based on prior history, there are, 50 years of example that if and when that train wreck occurs, it would look like the Great Depression in terms of a deflationary impulse. And then we know that the policy response would be, we are going to print whatever it takes. And the Fed balance sheet, just as the Fed balance sheet went from less than $1 trillion, 900 billion to, 3 trillion over 3 or 4 years with, QE and Bernanke. And then it went from 3 trillion to 9. It's come back to 7 under Powell. The next one's going to take the Fed balance sheet to 25. And at some point, the way, and I'm not suggesting hyperinflation is my base case, because it's not. It used to be a complete tail risk. I'm now thinking it's kind of a 10 or a 20% case. But the way that hyperinflation occurs is when people lose confidence in the currency and they say to themselves, just get me out of this currency. I know it's worthless.
Right.
And, if the Fed comes in and buys the entire U.S. government bond market, which arguably it would have to do if the stock market went down 40% and the bond market sold off hard and interest rates went up a lot, you're on your way. I mean, and that's a 200,000 plus Bitcoin price going to $1 million, and that's a $5,000 an ounce gold price.
As we just heard, Larry Lepard discussed the Federal Reserve's recent decisions. Now, let's delve into one of the most pressing issues: the growing debt spiral and its potential long-term impact on both investors and the economy. Larry highlights how inflation remains a major concern and explains how these economic factors could actually drive Bitcoin higher as a reliable store of value. With increasing pressure on global financial systems, understanding these dynamics is essential for anyone involved in the market today. Let's continue listening to Larry Lepard's insights on this critical topic.
And as you both know, and as we all know, first of all, the inflation numbers are a joke because they're not accurately calculated and they don't really reflect what we're all paying in terms of inflation. I mean, I had a home where the homeowner's insurance went up 100% year over year, and my auto insurance is up 35. I mean, there's just no way that what they're reporting is real. And, shadow government stats, John Williams has documented that for years. But being all that as it may, it is arguably lower than it was when it was at 9%. I mean, things are not going up as quickly as they were at the peak of, the pandemic and when they were still printing money excessively. And so, yeah, I mean, they've declared victory, but you've still seen some of the mainstream economists come out, like Cargman, have come out and say, well, they should have a higher target, which is just, absurd. And my view is it's really just a temporary phenomena before the next wave begins. And in fact, something we should go into it. I think what kicked off the next wave happened last week, which was when China came in, and very much like Mario Draghi saying, I'm going to do whatever it takes to save the euro. China said they're going to do whatever it takes to save their economy, and they did. They came full barrel with QE, fiscal stimulus, supporting banks, making direct deposits in banks. I mean, it was really quite stunning. And on that day that they did that, a lot of commodities went limit up. Mm-hmm. I mean, rubber, copper, tin, some of the other widely traded. And the messaging around it was very much of we will do whatever it takes to stimulate our economy and get it going again. So, and if you look at the charts and they're very widely available on Twitter of M2 growth, global M2 growth, particularly, China is it's going straight up. So they've got the printers turned on full blast. That has been reflected. I think last week also you had gold making record highs, mm-hmm. Silver close to breaking out of kind of a 3250 cap that it's been under for quite some time, and then Bitcoin coming nicely off the 58 that we were kind of stuck at, into the low 60s. So everything today is backing off a little bit, but markets breathe up and down. But the bottom line is that the fiscal situation, as James has so many times laid out, and I've laid out as well, that the debt doom loop that we've got absolutely requires that they continue to print money, because if they don't, the whole thing collapses. Right. And so they take turns. The U.S. does it at one point in time, China does it at another. They all add to the global M2. And so, my view, I think it's James's as well, is that we are going much higher in all of the assets that government can't print. Bitcoin's going to outperform gold, no doubt, over the longer term. But gold has always been more attuned to what the Fed's doing and inflation and monetary debasement, just because there are more gold holders in the world than Bitcoin holders, and they smell it early. And to your earlier question, Nat, of have they really turned the printer back on? I mean, the answer is no. But they've taken a couple of steps in that direction. They said they were going to stop tightening. They did that when things blew out last fall, and they got scared that the 10-year was over 5%. So that 12 people within 10 days came back and said that the rate hike cycle is over. And now the rate cut cycle has started. And then they took QE and they cut it in half. Actually, more than half. They took it from
60 billion a month. Yeah, 60 billion a month down to 25 billion a month.
Down to 25, exactly. And I predict that they're going to do probably 2 more rate cuts this year, and each one will probably be 50 bips. And the reason for that is that the interest expense is eating them alive, and they know it. And they've crafted the narrative in the way they have to craft it to allow them to do what they have to do. I mean, as James said earlier, they've got 2 mandates. They've got the inflation mandate and they've got the unemployment mandate, but they actually have a third mandate. It's not specifically in the legislation, but they've mentioned it many, many times. And that is what we call functioning financial markets.
Yeah.
and we know that when the third mandate comes into play, like it did in March of 2020, when the bond market went no bid,
right,
that they step in with enormous liquidity. And so, I think what we're waiting for is until that event occurs, and, Powell's going to have his own, Mario Draghi-like moment. He's going to be a deer in the headlights, recognizing, and the clue will be, the dollar will fall sharply. Bitcoin will be screaming, gold will be screaming, and the bond market will start to fall I mean, yields will go up, the prices of bonds will fall. And right now, the bond market's still somewhat tame. Everybody's doing the standard playbook, which is, the economy is going to slow down. Therefore, you want to own bonds because rates are going to be coming down in the future. So that's really the tell that both James and I are watching for. And you're starting to see it a little bit in the long end, right, James? I mean, in the 20 and the 30 year.
No.
I think what's going on, Nat, is that the world is waking up to what James and I have known for a long time, which is that they're trapped. They're absolutely trapped. And that's why you're seeing record high gold prices. And that's why you're seeing silver breaking out. And, gold smells it. And it knows what's coming. This is, as our friend Foss says, it's just math. There is no mathematical way out of this without them printing more money. I mean, if they don't print more money, the thing collapses.
In this thought-provoking discussion, Larry Lepard reveals the unsettling future that may lie ahead for financial markets and how Bitcoin could serve as a strong hedge against inflation. We'd love to hear your thoughts on a few key questions. Do you believe Bitcoin will outperform traditional assets like gold and stocks in the next 5 years? How do you view the Federal Reserve's role in stabilizing or destabilizing the current economy? For more Daily Dose Crypto news, check out these 2 awesome videos on your screen. Click now and we will see you on the next video.